Hi everyone, welcome back. Today I'm going to be showing how to find the intrinsic value of a company using the discounted earnings valuation. I'm also going to do Peter Lynch valuation and I'm going to go over my ratios, which is very important, at least to me. Um, but before we begin, if you like the spreadsheet, you can just go to my Patreon page. The link will be down below on the description. You can download it there and you'll have full access to it and you can do your own research on it. And if you like the content, please hit the like button and subscribe. It would be much appreciated. So back to the valuations. I'm just going to zoom in. So I'm going to start with Peter Lynch valuation. It's a very straightforward valuation, pretty much automatic. The stock ticker symbol, we don't even have to put it in because it already plugged in right here. So automatically shows up over here. Now what we need is the future earnings per share growth and the dividend yield. The P ratio automatically fills in as well. The dividend yield, we can get it from here, the yield, 533. So we plug in 533. In the future earnings per share, if you can't come up with your own, if you think that you rather use analysis future earnings per share, you can just plug in the ticker symbol Yahoo Finance and come to analysis. And the earnings per share, the growth estimate would be negative 8.19. Okay, so we would plug in. I'm not going to plug it in because to me, I think Pfizer is actually going to be growing its earnings per share by 4% next year. It's just way too low. The current price is just way too low, and that still gives us a 0.58. So according to Peter Lynch, it would be still overvalued. Less than 1 overvalued, close to 1.5 fairly valued, close to 2 would be undervalued, and close to 3 it would be very undervalued. So yeah, it would still be overvalued. Now for the discounted earnings valuation, one of my favorite valuation metrics, and relatively easily, all we have to do is put the growth rate. I'm actually going to put 4 as well. Because pharmaceuticals, they're slow growth stocks, so I'm gonna go with 4 or 3. Let's put 3. Be conservative. Okay. So once we plug that in, everything automatically just calculates by itself. The earnings per share automatically fills in. The discount rate comes in since we have it right here. This automatically calculated once we put in the ticker symbol right here, so we don't have to do anything. So we have the discounted rate, the P ratio, and the P ratio times 2. It just takes the P ratio and multiplies it by 2. Okay, so once we get the basic data fills in, what it does, it takes the earnings per share and it's gonna give us to the future. So what it does, it takes the earnings per share and the growth, as you can see, and it takes us 6 years into the future, giving us in 6 years the earnings per share. Okay, so when we get the 6-year target estimate, we're going to be able to get our 6-year intrinsic value. Okay, and what this does, as you can see, it's going to take the 6-year earnings per share and multiply it by the P ratio times 2, and that is going to give us this price. And now what we have to do is bring it back to the past until we get the 48. So this is the price we want for the next 1 year target. Okay, so within a year this should be the price of Pfizer. Down here is just the upside trend that we'll get from the current price till the intrinsic value. So yeah, that's how we evaluate it, and this would be our intrinsic value, as you can see right here in yellow. within 1 year. So once we have this valuation, we're actually going to plug it in, since it's the last one that we need to completely finish our valuation method. And our final intrinsic value would be 41. So according to all these metrics, we come up to $41.35. So this is the current intrinsic value of Pfizer. Down here, all we have is the current price, the difference between the current price and the intrinsic value, the margin safety being 20%. Our acceptable price would be $33. But if you want to take it a little bit further, let's say you want a 30% margin of safety, you would want to wait until 28.94, which is not very far, as you can see. So this is just going to give you a margin of safeties, okay, where you want to buy it. And down here, this is just the dollar cost average. This is my personal way of doing things. Let's say I want to put $1,000 into Pfizer, but if I think the value, the price is going to go lower, I would put only 40%, let's say $400 in my first target. In my second target, I would put 35%, 350. In my third target, if it goes even lower, I would put the rest, 25%. So as you can see, these are my, I have this chart over here and my targets right here. So my targets would be, my first target would be 3308. I would put $400. My second target, if the price comes to 28.94, I will put 350. And if my target 3 hits, if the price comes to 24, I will put 250. That's how I do it. I like to do dollar cost average. I don't like to put it in everything at once, because you never know. There's a lot of fundamentals going in that could, doesn't mean the price should go down, but it could, kind of thing. Now for the ratios, the dividend safety basically it just evaluates the dividend payout ratio, which is the proportion of earnings paid out of dividends. A lower payout ratio suggests that the company has more room to sustain or increase dividends. So what this is telling us right now is that they don't have much room to increase dividends. Okay, what this does is basically just takes the dividends per share and the earnings per share, and it's just gonna divide it and give us a percentage, an 86.26. So this means they don't have much room, but for Pfizer, to me, it's not very important, and I'll show you why. Because first of all, the current price is very low; it's only $29, and second of all, the dividend yield is actually pretty high. It's 5.33. So even if they don't increase dividends, or they have a little cut, you're still gonna get a really good dividend in the coming years. So next we have the debt to equity ratio. The debt to equity ratio is a metric that gauges a company's capital structure by comparing its total debt to shareholders' equity, calculated by dividing total debt by shareholders' equity. This ratio provides insight into the level of financial risk in the company carries. Okay, a lower ratio suggests a lower financial risk, indicating less reliance on debt financing. A higher ratio greater than 1 implies higher financial leverage and increased risk. Okay, so what we want to do, total debt automatically fills in, and as you can see, it's in blue, and that's because when we're doing the free cash flow valuation, total debt, we get it right here. Okay, so since we put it there, we don't have to put it here, it automatically just fills in over here. What we need to do is get the shareholders' equity, and for that we come here Sorry. Stock ticker symbol PFE. Okay, we want to come to financials, balance sheet, and shareholders equity down here. So we will plug in this number right here, 95,916. 95,916. Okay, and we come to a 0.22. So it's below 1. So lower financial risk, so that's good. I also put over here the definition if you want, in case you forget what it does. They have it on all of them, okay, as you can see. They're all here. So yeah, anyways, now I'm going to do the free cash flow yield valuation. So the free cash flow valuation, it's a metric that accesses a company's financial efficiency by comparing its free cash flow to its market capitalization, calculated by dividing the free cash flow per share by the market price per share. The free cash flow yield is expressed as a percentage. A higher free cash flow yield generally indicates that the company is generating more free cash flow relative to its market value, making it potentially attractive for investors, okay? So what we need to do is just get the free cash flow. I already had one in, but I'll just do it again. PFE. So stock ticker symbol. And now what we want is the free cash flow. We come to financials, cash flow, and we want the trailing 12 month, okay? So free cash flow, and we want this number right here, the 10,665. 10,665. Once we plug that in, market cap automatically fills in, and we get a total of plus 6.4%. So that's good. Now we need to do the current ratio. So the current ratio is a metric used to evaluate a company's short-term liquidity by comparing its current assets to its current liabilities, calculated by dividing the current assets by the current liabilities. A current ratio greater than 1 suggests that the company has enough short-term assets to cover its short-term obligations. This can be indicative of a good short-term financial health. However, a very high ratio might imply inefficient resource use, okay? While a low ratio could signal potential difficulty in meeting short-term obligations. So, sorry, let me plug in the battery. So, what we need to do is just get these two these two metrics right here. So what we need to do is come to Yahoo, which is, I already filled that in. Okay, and that's gonna be on balance sheet. Okay, current assets right here, first one, 51 to 59. 51 to 59. And now the current liabilities. It should be down here. Remember, if you come here, you need to expand all, okay? You need to expand all to get everything. And we need the liabilities, current liabilities right here. And we want to plug this in, 42, 138. Okay. So once we plug that in, we have the limit of 1. And the total came to 1.22, so that's good, okay? And now, last but not least, we have the interest coverage ratio, okay? The interest coverage ratio, it's a metric used to evaluate a company's ability to meet its interest obligation on the outstanding debt, okay? Calculated by dividing earnings before interest and taxes by the interest expenses. A higher ratio indicates that the company's capacity to comfortably cover interest payments, suggesting a lower financial risk. Conservatively, a lower ratio may signal potential challenges in meeting the interest obligations, implying a financial risk, higher financial risk. So what we need to do for the last one, just get the EBIT and the interest expenses. So we already have it right here, and we want to come to income statement. We're gonna get the EBIT, and 24,221, 24,221, and now the interest expense. Interest expense should be around here somewhere. Interest expense, not this one. Interest expense right here. 1,450. Okay, so once we plug this in, we come to 16, and as you can see, it comes out good. So that's okay. That's how we find the ratios, which it's really good to know how the company is doing, not only by numbers, but keeping track of its current assets, the liabilities, the shareholders' equity, and the interest expenses. Okay, so once we have that, all we have to do is plug in. Well, we don't have to, it automatically fills in. But what I was trying to say is, let's say you don't have this one on. If you don't have the discounted earnings, just fill them in. The one I usually take out is Graham's valuation. I just have it there, but I don't typically use it. And I'm just gonna use it for the sake of the video. As you can see, it just comes out. So doing all the valuations together, let me zoom out. Doing all these valuations, which are very important, you come to a final intrinsic value of $41.35. So I think this is a really good target price. Let me see what analysis actually have it. As you can see, the analysis have the 1 year target estimated at $38. So we came up to 41.35. I don't know how they come up with a number. I don't know if they do the same type of method, if they have some other method, but the price is pretty similar. So we have the acceptable price right here would be 33.08, and this I've already explained. So thank you for coming, and I hope you enjoyed it. And like I said, if you like the spreadsheet, you can just download on my page, and just hit that like button and subscribe. It would be much appreciated. Thank you. See you next time.